This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of our previous session, we saw how it was that we'd prepare on an income tax computation the calculation of tax liability and, if necessary, tax payable, but for us it was tax liability, on a combination of non-savings and savings income. What we know, of course, is that the personal allowance, which reduces our total or net income down to the taxable income, is deducted in a very strict order, at least for us with our particular exam paper. Non-savings, before savings, and eventually, as we'll see later in this lecture, then against dividend income. What that then does is to create taxable income figures, where we tax firstly the non-savings income and then proceed to tax the savings income. The non-savings income tax rates are very simple. Basic, higher and additional rate, 20, 40 and 45% there, depending upon whether the income remains within the basic rate band, extends into higher rate, or as yet unseen, or whether we go even further and up into additional rate. But the taxation of the savings income was a rather more awkward set of affairs there. It being that firstly, when moving on to that savings income, we had to determine, we haven't seen it there yet, about the application of the starting rate. We also then have to see whether or not the savings income nil rate band is available to us. Now that we saw in a couple of examples last time. Again, that then is dictated by, is the taxpayer a basic rate taxpayer, gets £1,000 savings income nil rate band, or are they, as per the previous problem, a higher rate taxpayer, and therefore it's only £500 as a savings income nil rate band. What we see now, I hope you've turned to it now in your course notes, here with example 4, is a situation where, again, pretty much par for the course these days, calculating income tax liability for our tax year, but we've only got one source of income, and of course that's bank interest amounting to £20,500. Now, as you would in any exam question where, to be fair, there's likely to be more than just one source of such income, we know that bank interest is savings income. So on our income tax computation, doing at the moment as you would in a full pro forma computation, we've got two columns, savings and total. Again, if you were doing an objective testing question, you wouldn't be bothering with the full pro forma working. You'd do just as much as you needed in your notes to be able to get you to the right answer. But the more varieties of taxable income there are, that mixture of non-savings, savings and dividend, the more it probably becomes important for you to maintain that columnar presentation there. So what have we got? We've got our bank deposit interest, let's just abbreviate that, bank deposit interest, 20,500. Again, of course, going into its analysis column, here clearly savings, and also the total column. That is the only source of income, so it's your total income, it is also your net income. Take away your personal allowance. That for our tax year, 11,500. Bringing us down, therefore, to a figure of, as well we're used to by now, taxable income. Taxable income here that will amount to £9,000. Right. Now, in our previous two examples, we had non-savings income to be taxed prior to the taxation of the savings income. We had a significant amount of trading profit. That trading profit was big enough not just to cover the level of the personal allowance, but also left you with taxable non-savings income in excess of £5,000. And the significance of that was for the taxation of our savings income, because it meant that there was no 0% starting rate band that was applicable. We only get the benefit of that 0% starting rate band for savings income if any part of our taxable, that's after the personal allowance, our taxable savings income, if any part of it falls within the first £5,000 of the overall taxable income. Now, that didn't happen in the previous two examples, because, of course, we had non-savings income, where the taxable income, from memory, I think was about 15,000, well in excess of 5,000, so there was no 0% starting rate band for when you came to calculate the tax on the savings income. Well, that of course has changed now. There is no non-savings income. We've only got savings income, and therefore all of that first £5,000 of taxable income, all of the first 5,000 of this 9,000 is savings income. So as now we tax that savings income, we're going to have the starting rate band, that's 5 there, 5,000 times 0%, your starting rate band. We use that first. We then look at the savings income nil rate band. Clearly, with these levels of taxable income, our taxpayer is just a basic rate taxpayer. So, Molly here, she gets the £1,000 savings income nil rate band, again, times 0% there. And that leaves you with, we've now accounted for 6 of the £9,000. There was £9,000 worth of savings and total taxable income. So that leaves £3,000 of this savings income figure that now falls into the basic rate band. And 3,000, of course, at 20%, we've had nothing up until now, that's going to give you some £600, and that will be your income tax liability. So a nice simple calculation here where savings income was the only source of income. Now, of course, what we are more likely to see in any question that we face in the exam is that, again, we get a mix of both non-savings and savings. We may also, of course, get dividend income, but that awaits us in but a moment's time here. So what have we got now in terms of example 5? Polly has a trading profit of £12,500. What does that make it? That is non-savings. Receives bank interest, £18,000. Savings income. So now, of course, in terms of your presentation, you're going to need your 3 columns, the 2 analysis columns, as per usual, of course, non-savings, savings, and as ever, a total column. And again, well, you should be able to do this very easily. You shouldn't need me to show you how to do that there. You know that the trading profit goes in as non-savings, your bank interest in as savings. We know then we'll take away the personal allowance. Where do we take the personal allowance from? From the non-savings to begin with. So we'll have that trading profit. We'll have that trading profit going in. 12,500. If I could sort the pen out here. And we've got our bank deposit interest. That was 18,000. Again, both figures repeated in your total column. And you come down to your total and indeed net income figures. At the moment, there's been no difference between our total and net income. We'll see what happens later with some qualifying interest payments or even loss reliefs that create a difference, a deduction from total to give you net income. Again, remember, go back to your pro forma computation. Make sure you know what goes where, and eventually the basis by which we include every one of those items. So the total income, it's untouched, £12,500 of non-savings, £18,000 worth of savings, and therefore 30,500 in total. Take away the personal allowance. That, of course, will be 11,500, all of which is then consumed by the non-savings income, leaving £1,000 of that to be charged, of course, there as taxable income. The savings income is untouched. There was no personal allowance to go against it. So what we have, 18,000 of savings, £19,000 altogether in terms of taxable income. And so we come to the tax calculation, made more interesting this time. This time we do have some taxable non-savings income. It amounts to £1,000. Now 1,000, of course, is less than £5,000. So it means when we move on to our savings income, the £18,000 then to be taxed, that the non-savings 1,000 falling in the basic rate band will have been taxed at, non-saving income, basic rate band, taxed at 20%. But the savings income now again needs that rather more detailed calculation. That mix, of course, of tax rates that will be applicable to it. Do we have the starting rate band available to us? Answer, yes we do. We know that we do because only 1,000 of the first £5,000 of taxable income, only 1,000 there is non-savings. So that leaves 4,000 of the 5,000 starting rate band available to be used against the £18,000 of taxable savings income. So 4,000, the starting rate. After starting rate, then we look at the savings income nil rate band. Basic rate taxpayer, as we see, only £19,000 of taxable income there. On that basis, that leaves £1,000 of savings income nil rate band available to you. So again, at a 0% rate. And then the rest of it, all in the basic rate band, will be taxed at 20%. We then use the normal savings income, same as the non-saving income rate, 20% in the basic rate band. I'd like you to finish off that calculation for me, please, there. And once done, check through the answer, make sure that you are happy with it. And then once you've checked that through, I would like you to open up your notes. We have to just go back a little bit here to what we had not made mention of last time, but that was the taxability of your dividend income. So if therefore you pause at this point in time and then go back, work through that example, look at the model answer, shouldn't take you very long, and then rejoin us for now asked to see the final piece in the jigsaw of the taxation of taxable income. How do we then, after non-savings, after savings, how do we then tax our dividend income? Okay, so back we go therefore now and look at that tax treatment of the dividend income. Now here we're going to see some very, very different tax rates applying, again depending on whether any taxable amount of the dividend income falls within the basic rate band, the higher rate band, and of course thereafter the additional rate band. But a little bit like we had with savings income, we also benefit on our dividend income from a nil rate band. This time it doesn't vary, it's the same whatever level of taxpayer you are, whether you're basic, whether you're higher, or whether you are indeed additional rate. Everyone, as you'll see from the notes here, will benefit from a £5,000 dividend income nil rate band. Let's have a look at our notes here. So we've agreed that after taxing, firstly non-savings, then savings income, we then move on to the taxation of the taxable amount of the dividend income. And it will firstly benefit from this 0%, this dividend income nil rate band. And it's the first £5,000, again, irrespective of whatever level of taxpayer we are, irrespective of whether dividends fall within, just make we can see there, doesn't matter whether we're basic rate, higher rate, or additional rate band, every one of us benefits from a 5,000 dividend income nil rate band. So you're only going to pay tax on any dividends if you receive more than £5,000 worth of dividends in any tax year. It means that, of course, for the vast majority of taxpayers who just have some shares held within companies, that those dividend figures will easily fall within the nil rate band, and on that basis there will be no tax to pay. But that is a rate band, it is a rate of taxation, and therefore, just as it was with the savings income, with the starting rate band there, the nil rate bands, they count towards the overall basic rate band limit and eventually higher rate band limit. As we said there, dividend nil rate band counts towards the basic rate and higher tax rate thresholds. So again, it's pushing us ever closer from basic into higher rate and then up into additional rate there. If you look at those rates, they're very different, of course. Now, again, don't panic. All of these rates are on your rates and allowances page. Probably by the time you hit the exam room, you'll have no need to refer to those rates and allowances. You will know them very well by then. But they're there, available to use. They are 7.5% for any remaining amount of dividend income, so above £5,000, that then falls into the basic rate band. That 7.5. But if some of that dividend above 5,000 has gone above 33,500 of total taxable income, then you're up into the higher rate band. Go further up into the additional rate band, you go over 150,000, then we see different rates yet again. And suddenly those tax rates change to rather more serious numbers, from 7.5 to, in the higher rate band, 32.5%. And once, if you get into additional rate band, 38.1%. Now there's a little note here which you don't have to worry about, it's just a little bit background history. You see something like 38.1, you think, well, that's a very odd figure there that we've got. Well, it all comes down to, it's all arisen out of what was a fundamental change in 1617 to the taxation treatment of dividend income. Prior then, as it says here, up to 2015-16, there was a very different system by which, and you'll be pleased to hear this, a very much more complicated system, thank goodness we don't have that now, that dealt with the taxation of dividend income. Now it's very simple. Where these rates come from lies in history. They did it to create an extra tax charge. There's seldom changes, of course, that reduce tax charges there, but effectively across the board, whether you basic, higher or additional rate, it meant that with the changes they put through, effective from 1617, still the case in 1718, that we were paying an extra 7.5% in relation to tax rates on taxable dividend income above that nil rate band. So we benefited to begin with from the nil rate band, but then the tax rates got higher. Okay, let's have a look now at an example that will involve the use not only of these tax rates, but all the other tax rates that we've seen, a mix of the different sources of income. So we got as far as example 5, so let's just get through now, if we can do it, to example 6. Right, this time, income tax payable. Now, as soon as you see that it's income tax payable they want, you know that there is going to be employment income involved within the question and that there will be PAYE given to you. Without that, there's no difference between tax liability and tax payable. So here, salary, our employment income, 18,500. That, remember, is non-savings. And we've got PAYE deducted at source on the payment of the salary to the employee, deducted by the employer, paid over by the employer then to HMRC, of £1,400. We received £10,000 of bank deposit interest, savings income, and dividend income received of £2,000, clearly dividend income. So we've got the three sources, therefore, of our income. So you will need, again, you'll need rather more room than I seem to have available here, but you'll now need an income tax pro forma that has all 4 columns on. We have got non-savings, we have got savings, we have got dividend, and of course, as ever, we have our total column. We've got our salary, our employment income, 18,500. As we already know, non-savings, and into your total column. We've got bank deposit interest, some £10,000 there, savings income, in it goes. And finally, we've got our dividends received as well. How much were they? £2,000 there, into the dividend income column, and of course into your total column. So all of these figures the same. That was 18,500. That's 10,000. That's 2,000. Cross cost, 18.5 plus 10 is 28.5 plus 2 is 30,500. Check down, of course, 18.5 plus 10 plus 2. Here, exactly the same calculations. And on that basis, 30,500. That is your total stroke net income here. And of course, we deduct the personal allowance. We again remember now, of course, how much that was, 11,500. And that it is deducted firstly, and here only from non-savings income, given that the non-savings income is, of course, bigger than 11,500. It absorbs all of that personal allowance. So our taxable income figures will therefore be 11.5 away from 18.5, so that's going to be what, £7,000. That's untouched at 10. That is untouched at 2. 7 plus 10, 17 plus 2 is 19. Is that the same as 30.5 less 11,500 there? Yes, it is, so we know we've got the correct figure. Always do that double check on your calculations there, cross-cast, to make sure you agree that total. So it's then about the calculation of the tax thereon. Now then, look at what we have got. First of all, in terms of our total taxable income at 19,000, the taxpayer is a basic rate taxpayer. What do we tax first? Now, I'm going to talk you through this. You're going to do it. Then we'll look at the model answer together in a few moments' time. So, the £7,000 non-savings income. All of that, of course, within the basic rate band of 33,500. So all of the 7,000 will be taxed at 20%. 7,000 of non-savings taxable income. What does that mean then about the taxability of your savings income? It means, of course, that there is no 0% starting rate band to use. That at 7,000 is more than 5,000. So as the first 5,000 of taxable income is all non-savings income, there can be no 0% starting rate band. We are a basic rate taxpayer, however, therefore the savings income nil rate band will be £1,000. So the taxability of the 10,000 then follows. Of that 10,000, 1,000 savings income nil rate band, so at 0%. The remaining 9,000 of that £10,000 will of course fall into, as all of this income falls into, the basic rate band. And within the basic rate band, of course, it will be taxed at 20%. The dividend income, well, that's the new bit. What tax rate will apply to that 2,000? Look back at your note if you need to, but I hope that you remember. None of us will pay any tax on our dividend income. That, of course, is going to be less than £5,000. That's only 2,000. So all of the 2,000 is within the dividend income nil rate band. On that basis, therefore, it will all be at 0%. So on that basis, what I need you to do your calculations, show your calculation there on your computation, and then check out with the answer at the back, please. I'll just pause this, and again, then when we come back, we'll have a go at example 7. Okay, well, hopefully you were all able to do your calculation of the income tax liability correctly there, given what we said about the taxability of the 7,000 non-savings income in basic rate band, all at 20%. The 10,000, no starting rate band available, but £1,000 of savings income nil rate band. Why 1,000? Because the taxpayer is a basic rate taxpayer there, as you can see. So 1,000 at nil and the 9,000 in the basic rate band, therefore at 20%. Moving on to dividend income, it is less than 5,000, therefore all at the nil rate. But of course, did you remember that the requirement was to calculate income tax payable there? Again, okay, I would have distracted you by talking you through all those calculations, but never lose sight of what the requirement of the question is in your exam. This was income tax payable, and therefore you had to come back and deduct the PAYE of £1,400 from that income tax liability to give you the income tax payable. So again, watch out, be careful in the exam. Okay, We now move on, therefore, finally in this lecture, to look at example 7. Again, we've got the requirement to do income tax payable, so there's going to be a deduction of PAYE, here's some £5,000. Daisy received a salary, 36,500, as ever, non-savings. Bank deposit interest of 12,000, savings. Dividend income, 2,000, dividend income, of course. 2,000, you're already ahead of me, I hope. That is less than 5,000, so whatever level of taxpayer we become, as we'll see soon in our tax calculation, whatever level of taxpayer we become, we know that the dividend income will all be within the nil rate band. What would have happened if it had been more than 2,000? Well, we will see. If you go back to the question we've just done, again you had £2,000 worth of dividend income. What about if that had been £7,000? Well, if that there, instead of 2, had been 7, then we'd be adding 5, so your total would be plus 5,000, so that would be what, 24,000. So you'd still be a basic rate taxpayer. So when it came to the taxation of the dividend income, if that, as we've said, was now £7,000 in there rather than 2, the first 5,000 of that 7 is the dividend income nil rate band. That still leaves £2,000 of dividend income above the nil rate band and within the basic rate band, given our total taxable income would now have gone up to just 24. So therefore, back to your tax rates if you need be, if you had taxable dividend income all falling as it would within the basic rate band, it would be that 7.5% rate. What are we going to see here in this question, in example 7? Well, when you look at the numbers here, 36.5 plus 12 plus 2, add those figures in there, we're up to, what's that, 2 plus 12 is 14 on a 36.5, just over 50,000. So even when you take away your personal allowance from that, you're going to have a taxable income figure in excess of £33,500. Therefore, the taxpayer will be a higher rate taxpayer. Now here, it'll make no difference to the taxation of the dividend income because it's all at nil rate. But of course, it is going to make a difference to the taxability of that savings income. Okay, so we'll need to set up our pro forma. I would like you to do that now for me. Set up the computation and work down, please, to the taxable income figure. Work down to the taxable income figure. Again, I'll pause at this particular point while you do that. Join me again when you've got your taxable income figures and we'll check through them together and then proceed to do our tax calculation. Okay, let's have a look at what we should have and hopefully you too. We know what the individual figures are for your salary, your employment income, i.e. non-savings, your interest, your savings income, and your dividend, obviously dividend income. In those figures go. We know the personal allowance is always deducted firstly from the figure of non-savings income, which is more than big enough to absorb that personal allowance. Meaning that we end up hopefully with £25,000 worth here of taxable non-savings income, the untouched £12,000 worth of savings income, and the equally untouched £2,000 worth of dividend income, totaling some £39,000 worth of taxable income. So at £39,000, that falls between the basic rate band limit of £33,500 and the higher rate band limit of £150,000. So the taxpayer is a higher rate taxpayer. Okay, so the calculation of the tax that now ensues. You know the order. You should be able to tell me, as it were, here what we do first. What is the first bit of our taxable income to be taxed? It is, of course, non-savings. How much non-savings do we have? 25,000. I've written the full 25,000 straight in because 25,000 is less than 33,500. So all of the taxable non-savings income falls within the basic rate band and therefore will be taxed at or times 20%. The non-savings income dealt with. But now we've got £12,000 worth of savings income to deal with. First of all, given that 25 is more than 5,000, there is no 0% starting rate for us to use. So, do we get a savings income nil rate band? Yes, we do. We are a higher rate taxpayer and therefore benefit from some savings income nil rate band, but only £500. So of that savings income, we know £500 will be at 0%. We then come to tax the remaining 11,500 of that £12,000 there. As we see, the first 500 is within the savings income nil rate band. Now, normally when we've seen this before, all of the remaining savings income falls within the basic rate band, so it's all at 20%. But now there is an issue. If we were adding 12,000 there to 25,000, then that would take us in total up to £37,000. That puts us above the basic rate band limit. So how much of our basic rate band limit now remains? Well, the basic rate band limit is 33,500. Again, you know it, but it's in your rates and allowances page. And what have we taxed so far here with those two numbers? 25,500. So 25,500 away from 33,500, and that will leave us with £8,000 of the remaining savings income to be taxed, all falling within the basic rate band, and therefore to be taxed at 20%. That means of the £12,000, we've now taxed 500 plus 8,000, 8.5. That still leaves £3,500. Add up 500 plus 8,000 plus 3.5. Is that £12,000? That figure? Yes, it is. So we've correctly accounted for it. But that 3.5 now has taken you up into the higher rate band. And just as with non-savings, the savings income higher rate band tax rate is 40%. So an interesting calculation there of the tax on the savings income. We don't have any starting rate, but we do have some nil rate. How much is it? Only 500. Why? The taxpayer is a higher rate taxpayer. We're still then within the basic rate band, but there isn't enough basic rate band still available to fully cover all of the taxable savings income. So the first 8,000 of the remaining 11,500 to be taxed is taxed at the basic rate. We then push up into higher rate band, which is taxed at 40%. Now we come to dividends. That is only £2,000, which of course is less than 5,000, the dividend income nil rate band. Again, there's a lot of nil rate bands I know floating around there, but make sure you identify what is savings income, what is dividend income. So all of that at 0%. If here your dividend income had been more than 5,000, then had that been the case, for example, had it been again 7,000 as we changed in the previous example, our dividend income of £2,000 too, if we now make this 7,000, then what now would that particular row on our computation read? The dividend income, firstly as ever, 5,000 would be at 0%. That would be 5 of the 7. The remaining 2,000, clearly we're in higher rate. We're nowhere near the additional rate band. The higher rate band limit is 150,000, so no question of additional rate here. So that would leave the remaining £2,000 in the higher rate band. Now you will have to look back at this. I don't expect you to have remembered it. Look at your rates and allowances. And in the higher rate band, dividend income, once you've used up your dividend income nil rate band, is that weird and wonderful 32.5%. And you calculate the tax accordingly. Right. This version, of course, is what what this question actually gave you. Work out what that comes to. Remember, that will be your income tax liability. They wanted income tax payable here, so you'll need to deduct the given figure of PAYE. Check that out, please. Understand then, If the dividend income had been 7 rather than a mere 2,000, it would have been an easy calculation still. 5,000 at 0%. What is left over? 2,000. It is in the higher rate band. It would therefore be 32.5%. Okay, check out the answers to that. That brings this particular session to a close. Next session we'll move on to look at an odd little item in terms of interest income, where we have government securities or corporate bonds, something called the accrued income scheme. Again, just a little calculation exercise that needs to be done there. And then, rather more interesting than that, the use of the personal allowance. Up until now, it's been very simple. Just deduct £11,500 and given personal allowance. But you may recall in our first discussion about personal allowances, we said that there would come a point above which you would start to lose your personal allowance until eventually you had no personal allowance available. We'll see what that is all about in our next session together.